Today's guest has been a major influence on how private wealth management is practiced at the highest levels. Christopher Poch is the founder and CEO of Promethium Advisors, LLC. Chris has spent more than 40 years advising some of the world's most successful families and helping shape the industry itself. He built and led wealth management groups at Smith Barney, Citigroup, and later the Bessemer Trust, and firms known for serving complex multi-generational clients with institutional level degrees of sophistication. His new book, which is why we're chatting, Money and Meaning, What I've Learned from Advising the Very Wealthy, distills decades of insight into deeper questions of wealth, not just how to build it, but how to align it with values, family, and a life of purpose. We're going to talk to Chris today about some of his core observations about wealth management, but also what truly drives fulfillment in a world of abundance, although not all of us are living in a world of abundance. The patterns he's seen among the very wealthy, and what all of us can learn about finding meaning through our financial lives. So, Chris, thank you so much for joining me today. How's it going?
Good. Harry, thanks so much for the invitation. And as let me paraphrase what I heard one time, that's an introduction that my father would be proud of, but only my mother would believe. So thank you. It's a pleasure to be here.
So, this is going to shock no one, but I'm definitely not an ultra high net worth individual. If you were going to speak to us ordinary folk about managing our wealth, what would you say? What's applicable to all of us?
This ultra being an ultra high net worth really is a mindset, and it's really not how much money you have. It's really at some point in your life you stop thinking about what money can do for you, and you begin thinking about what money can do for others. And so, whether that other group of people is your immediate family, your community, or even society at large, if you have a lot of it, that's really when, in my opinion, you become, ultra wealthy because you have enough. And so, how that applies to different people, there's certainly tax code issues and that kind of thing that we deal with, but it's really getting to a place where you feel like the main point is money's not the main point anymore.
Okay, so I'm definitely not ultra high net worth. Um, but I will say one thing that it's something I've paid attention to, and as I get older, I pay more and more attention to issues about the cat tax code. And the big regret I have is not understanding the US tax code well enough to see the huge advantage in uh, tax exempt retirement accounts. And that's the thing I have big regrets about is not optimizing my use of Roths early enough. Is it just me, or is everybody else sitting there with $2 million in Roth accounts, or does everyone else understand how to use these things, and how would you advise people to use them?
So the quick answer is no, most people don't know. And the retirement plan system and I don't know, 40 or 50 different types of retirement plan accounts that you could have is really very complicated. I don't know that you've missed too much in not understanding all the elements of the tax code, but as they say to the ultra high net worth, April 15th is not tax day. Every day is tax day.
Right.
One of the things that you find that, kind of for normal people, most of the tax professionals use the same tax software or basically all, worked off of the same code. The element really is to speak with somebody who actually can be a tax advisor as opposed to somebody who pops in the number and sends you a bill. So the Roth is one. There are other different types of, these opportunity zones have certain Roth-like elements to
Hmm.
it. There are many people that use insurance to significant advantage for leverage. The, the the most profitable kind of insurance is if you buy it and then die immediately. So you're not alone there. And I do think uh, it behooves people to spend a little bit more time with a real tax professional and even, God forbid, go to a regional tax planning conference where it's really designed primarily for the professionals. What I try to do is I try to go listen, I try to go meet some people and I just listen to what they're doing. And some people deal with, business owners with 15, 20, $30 million, and that's great. And then other people, deal in the very wealthy and use, private family banks out in these various states with the ability to sort of, kind of hide who owns it, with LLCs and jurisdictions which are difficult to enforce charging orders, all that kind of stuff. So it can be very complex. And I didn't mean to get too far down that rabbit hole, but spending a little bit more time understanding the tax code and not just trying to outperform the S&P is probably a worthwhile effort.
Um, I took a look at your book and I
Thank
noticed
you. I'm now it's you and my mother. Thank you. I appreciate that.
there were a surprisingly large number of reviews as well, mostly positive. People liked it. So I noticed certain core phrases, the quality filter and your emphasis on owning quality, the interdisciplinary thinking. Can you outline the thrust of your arguments, summarize a book in 5 sentences? Seems unreasonable, doesn't it?
Yeah. So let me lean into quality a little bit. So part of this comes to, what are you trying to accomplish? Are you trying to outtrade the market? Are you trying to make the most money possible? Or do you have a short-term time horizon? As you know, 70, 80, maybe 90% of the volume on most of the stock exchanges are run by people that have extremely short time horizons. So the question is, what's your time horizon? And I live in the world of paying taxes, right? For people who pay taxes, trading typically doesn't work after tax. We all want to buy the next Apple, Amazon, the ones that can compound over 10, 20, 30 years. That's very difficult. But if you have a mindset of trying to own companies that if you buy at the wrong price, that the company itself and the management and the business and the competitive moats will, take you out of there. I tend to recommend for clients to own financially strong companies so that if there is an unforeseeable miscue, you're not leveraged up to the wazoo and there's a really large price, decline or what have you. So as far as quality goes, that's what we recommend. Again, once you have a lot of money, whatever that number is, um, the real objective is to have a diverse set of secure rising income sources that will outperform inflation after taxes and fees. What that does is it lifts your standard of living. And once you get to this point in your life where you have enough and you're sort of a net saver or anything that you're making is going to your grandchildren or whomever, then what you want to do is you want to live uh, a life that you don't have to worry about the volatility of the market. So when you own quality assets, whether it's a good piece of real estate, terrific intellectual property, or common stocks or a business or what have you, then you don't really have to worry as much about it. And that's the peace of mind that we talk about. The goal for most of our clients, and I think me and maybe you, hopefully all of our people on this call, the end game is peace of mind, and financial independence is a stop along the road. So that's the message that we have throughout the book. And how we get there, how do we do the things that we should do for the people that we really should be thinking about, um, that will lead us to, feeling good about it, not having to worry about every blip in the Dow or the S&P.
I know I'm circling back a little bit when I talk about managing the net result. We're going back to the tax question, but how does one go about managing that? I mean, it's a logistical implementation question. Give me some ideas on managing that net result.
Yeah, so there's certain things that are reasonably simple, right? So having the proper ownership title of certain kinds of assets. Obviously, you've got retirement plans for most of the people on this call. Products like annuities are probably inappropriate. So those kinds of things are important. If you can own a series of assets, um, and have them be, a Berkshire Hathaway type of thing, you could choose to take income or not. I think one of the things I try to tell people is we would like to hold assets for, 5, 10 years, and that's probably not our average holding period. It might be the, to the it skews to the amount of money that we have. Those tend to be larger in the portfolio. I mean, if you have a really good portfolio, it ends up looking like a venture capital trade, right? Because you keep one or two or three and they become 60, 70% of whatever the number is. But the other thing I say is, don't beat yourself up if you have to sell a stock after 3 or 4 years and you end up paying taxes. If it's a small business, you can do some qualified stock business exchanges and things like that. Um, we also recommend, I don't get paid to place real estate transactions or what have you, but we believe in, buying local real estate wherever local is to you, where you know the people, you like whatever it is that they're doing. We tend to look for cash generating properties that are mature, stable, run by, good people, have good tenants. And if you get cash out of that, your cost basis goes down and down and down and down. And after X number of years, there's a little bit of debt on it invariably. You refinance it, you get the money out, but you still have your equity position, and you have maybe rising cash flow if it has any sort of economic tie. And then maybe 10, 15, 20 years down the road, God forbid you pass away and that money goes to your heirs on a stepped up basis. So there's a lot of people who've made money in the markets, and most of those people who've made money in the markets are investment professionals. And then there's some people who've made money in the markets, and the next group are the people who have founded the companies and never sold their own stock, right? And then, you know, but if you take a look in your own community, depending upon where you live, but I live outside of Washington, D.C., most of the really rich people here made it generationally through owning real estate. And I think real estate's an important component. So for those who are here, yes, you own your home and maybe you own, a snazzy place near the beach or whatever. But, buying a little partnership of a boring shopping center may not be a bad idea. So there are ways to get to this net retention of affluence and keeping, money in the coffers and minimizing the tax, but don't go to any great lengths to try to avoid it altogether.
You know, it's funny. About 5 years ago, I really wouldn't have understood what you just told me. And about 5 years ago, I started buying real estate around me. It turns out if you're going to own real estate, it better be close. Otherwise, you're going to do a lot of unpleasant traveling because you have to have someone else manage it. If you have to have somebody else manage it, you're then constantly checking managers of your real estate because not all of them are very good. But yeah, the arithmetic of it is a very curious thing. And I would never have understood the power of some of these things over time. That if rents are going up, you're gonna drift into a relatively strong position, and then you get that step up basis if your kids inherit. So in the night, and you never have to pay the tax when you refi. And I've just gone through one refi recently, and I'm just going to do another one later this year. Um, I got lucky. Rents went up. I do wonder what would have happened if I'd bought in the Midwest. Rents might have gone down, and maybe it wouldn't be so pretty.
Yeah,
So,
so something like 70% of the population lives within 100 miles of the water. You want to go where the demographics are growing, and then don't be too clever by half, and just sort of like get into some place which looks reasonably good with people that appear to be honest and have a good reputation, and let them manage it and give them some of the upside. And I don't know. So when we talk to clients, wealthy families own a ton of real estate. That's the reality.
mhm.
So to absent it and not to, to pretend like the stock market is the only place where we make money completely challenges your credibility. So those are the kinds of things that you can do. And then as you talk about estate planning and involving the, adult children, there's different ways you can involve them. Obviously, people talk about philanthropy, and that's a good one. Maybe you have somebody oversee part of the, a real estate property and see how they do it. And, if you've got multiple holdings, you can test them out on, one. And if they butcher it, you sort of, ease it back. So there's lots of different ways where, um, you can help build wealth, manage wealth, defer taxes, Know that the tax code is going to change. Don't get too upset about it when it does. Just know it's going to change. And then ultimately, the balance that I think most of the macro capture, audience is they balance their own life between this desire for achievement and success and maybe financial wealth. That's one thing. And yet, at the same time, and I'm speaking about myself, by the way, Harry, I have to, at the same time, try to be the example of the person I want my kids to admire and become. So to me, that's part of the whole balancing thing, and that's part of money and meaning. And then once you have a lot, whatever a lot is, or once you have enough, then you got to figure out, did I ruin my family in the process? And hopefully not. And if so, what do you do about it? So that's kind of the things we talk about.
So, how about interdisciplinary thinking? Can you explain why that's so important?
That's a word that has so many syllables. I'm surprised I used it, Harry, but let's just assume it's in there someplace. By that, I mean, when you basically you've got one or two lawyers typically need to be on your team. You have a tax person, you have an investment person, you might have a risk person or an insurance person. So you have these interdisciplinary, advisors. And I think building a team of advisors is a very important thing. You want to get people that are competent. Most of us can't afford the big four types of people from taxes, and a regional firm will do just fine. But having people that on your team that are all aligned, they'll communicate well together. They have overlapping expertise so that nobody sort of, corners them off and tries to recommend too much to go into too many things. But as you set up, sort of the legal structure of how you want to own assets, where and what you want them to do, some assets, if you're lucky, can be 30, 40, 50-year assets. And some assets are going to be, um, shorter term. But having, the type of vehicle and where it's located and who's in control and who's the beneficiary and who's maybe the trustee. And you have these nested entities of LLCs and LLCs and managing this and what have you. There's different ways that they all can connect together. And it sounds pretty complicated because it is. But the point is, if you don't educate yourself up front about the possibility of these things, you can't advise, sophisticated clients who have these balance sheets, and uh, they've got an org chart that might have 60 or 70 different entities in it, right? So, and that's not hard to do, particularly when you have a lot of different business interests. So it's A, understanding the legal element of it, and then B, understanding the control element, and C, understanding, what's actually in a K1 and how that can have like 70 different types of contributing things in these little boxes. So I encourage people that are really serious about working with the wealthy people, and even for their own edification, I'm sure most of your people are intellectually curious about understanding how all of these pieces work together and how to be complementary with the attorney, with the tax person, and how to learn with and from them. And you become, I think it's more interesting. You become a much better advisor, and you probably, do one or two things that are less stupid than, without a lot of foreknowledge. So that's what I'm talking about, this interdisciplinary thinking.
I've found, so you can probably tell I've got some connection to the UK. I live here in Massachusetts with
We
my
call that Taxachusetts, I think, don't we?
well, I'm from the UK. It doesn't seem that bad to me. Going back to that real estate conversation, the reason why I got involved in it, and by the way, dirty business. If you manage it yourself, very dirty business. But I got involved in it because compared to the UK, the tax breaks in the United States are astonishing. Okay. So, but yeah, I was shocked when I read about it, and I thought to myself, this is so biased. The finger on the scale is so fat that you really have to do something. And the only question is whether you manage it yourself. I only manage it myself because I've learned I have trust issues. Um, one of the I think you're in a privileged position, Chris. You talk to a range of people who have really good looks in different corners of the economy. And they probably got a good insight into what they do. Otherwise, they wouldn't have done so well at it. But these are curious times. I'm wondering how your clients are looking at the current moment compared to the past. Like this morning, I sat thinking we might see quite choppy markets because Jerome Powell revealed that he was under a Department of Justice investigation that was being subpoenaed at the Fed. Um, and the market shrugged it off completely. I'm an idiot. Doesn't matter. Not the first time. All fine. But I think these are curious times. Am I the only one?
No, Harry, obviously, most of us are wondering what's going to come out of the administration. I mean, I'm literally blocks from the White House, and they're very curious times. And the only thing I would say is, and yet that seems to be the case most of the time, although I think most would argue on both sides of the aisle that Donald Trump is a wild card I don't think any of us have seen before. One of the things that I sort of punt, right? I do understand the vast majority of the people on this are, more active investors than I am. And by the way, most of you probably generate high rates of return. So the last thing I want to do is, opine on the markets from a position of, knowledge. But what what we try to do is we'll work with clients, and some of these clients do have deep industry expertise, and it's very narrow. In those areas, I just learn from them. I've got some very sophisticated, financial services people and cybersecurity people as clients, and some, senior bank regulators. But what as far as the time goes, I try to look for the second derivative trades. That's kind of been where I've been most of my life. And it's sort of the Kelly criterion, you get to what's the other guy going to think? I'm going to think, they're going to think. And then, so we try to stay away from the most volatile stuff and try to, um, ask why isn't the dog barking where? And then we try to buy financially strong companies that are going to be, the beneficiaries of pictures and shovels, that sort of thing. So we were relatively early in the Texas data center thing, and we did quite well. It's had a lot of run ups and down. Um, we think AI is absolutely going to be here. We think quantum computing is coming. There's going to be a ton of money throwing in all that. It's going to be a national security. It is a national security. You have to have these data centers inside the United States. You need them in places where there are no people or regulations. You need them where there's lots of energy and lots of abundant water. You need things like that. So, we will go and we will be early, and we've been early, but right now it's, working in our favor. And another sort of trend that's been going on since you and I have been in the business, and I think I got you by a year or two. There's been an increasing a shortening of the attention span, a shortening of, when you think about options back in the 70s when they were, invented, and then even probably up into the 90s. I don't know the date on this, but you'd have an option that would on General Motors that expire once every 3 months, every 5 points, and then it came, and now we're at 0 day options to get around the short selling rules basically. And you could do it on ETFs. And but so you've got this 6 sense fear, 6 second fear of missing out, the Instagram thing. So how do you take advantage of this lack of a long-term view? Well, what's the one thing that benefits from all of this frenetic activity? Securities exchanges. You take a look, the last 20, 30 years, and you take a look at the owner of the securities exchange had a rate of return which is about 50% higher than the index average did on, the New York on the CBOE, CME. And so, this is going to continue to happen, right? So, we just bought, the basket of security exchanges and say, if it goes up, great. If it goes down, great. If the contract goes someplace else, it'll all get ARPed out, great. As long as I don't care, which direction you go over the bridge, as long as the volume keeps going up. So there are certain things that, you can do as a long-term investor. Um, And I don't try to pick one and then be right or wrong and on the edge of my seat. We try to pick, a basket. We concede we're going to get the average of whatever the good sector is. So, um, we are long term. I do try to pay attention. Um, but I think there's ways you can deal with that.
Um, so one of the things I was struck by in the book and in the conversation we've had, the kind of pre-discussion conversation, was your emphasis on succession planning and family education. And, I wouldn't describe myself as an ultra high net worth individual, but I had relatives who were pretty well off. And when I chatted to my cousin, who did very well in Eastern Europe, about his concerns, he had a health problem which made this particularly pertinent. Um, he talked about his concerns about his kids, that the problem with having uh, very large amounts of wealth was you can easily demotivate your children, give them no reason to really work at anything, and take away their direction in life. Um, tell me, talk to me about this whole question of succession planning, how to educate children, how to deal. I suspect my cousin acted as if having a large amount of wealth was actually a burden and a problem with respect to his kids, not an advantage. Talk to me about that.
We hear that all the time, right? After a certain amount of money, more money is just a bigger problem. You become more public, you become a target. There's all kinds of, it's not just fishing and that sort of stuff, but it's social sort of pressure to give money to these causes, to show up here, to whatever you do, it's not enough for whomever you're talking to. So, that's part of learning how to do that. The thing that I just say to people is there's no, magic bullet or little pill you can take to solve this. This takes 10 years to get right. And one of the things I I really firmly believe, if you want your kids to listen to you, you got to listen to them. And it's time in the car driving whatever. It's time where you're learning together and co-creating together. Because if it's, parent down to child, there'll always be a natural element of resistance or ignoring or what have you. But if you can put together environments where you're learning, you're doing something together, and not just, going to the game, but actually learning something together, and you're listening, and you're not trying to have your child be perfect with 30 years more experience, today than they have. So there's also a series of structural ways where you can, help encourage them to, take a little bit of risk, be right or be wrong, understand the emotions, the highs, the lows, don't beat them up too badly when they make mistakes, which they will, and they will again, and they will again. So it's a long discussion. One of the things that some parents do is they make the mistake of, holding control too long. I'll give you a quick example. So I've got to hide this a little bit. An older client who has a big charitable foundation, and his adult kids. I've said, how do you get them involved? And he said, well, I've told them that they just tell me, who they want money to go to, and then I'll write the check and I'm going to go to them. I said, no, I said, have they done it? He said, no. And I said, that's a disaster. I said, what you should do is write a check and put, 50 grand into their donor advised fund, and then leave them alone. And then it'll really be theirs and they'll figure it out, and there's a number that's multiples higher down the road. But it's this sort of thing where just a little bit of advice like that, and my client took it, and it's actually worked out marvelously. So, this whole thing about having a ton of money, it's really, it takes people a decade to understand, my name is something that people see in the paper, or they know that we own the grocery store, or whatever it is, and learning how to deal with the responsibilities, the pressures, the subtleties, the slights, all this sort of like bad stuff that shouldn't happen. It's a maturation period, and parents would be well advised to start telling their kids, at age 20, these kinds of things may or may not happen to you at age 25 and age 30 and age 35. And, it's coming, right? So, um, learn to deal with it. And somebody said everything you want in life is on the other side of hard. I don't know who said that, but I like it because it almost never gets easier. You just need to learn how to deal with hard better. That's from the women's coach at Duke. Um, so in any event, there's lots of tactics and plenty of advisors out there. My only advice is if you want your kids to listen to you, become a better listener, and then help them understand that this is not something that they're not going to learn and it'll be done. It's a very gradual evolution that takes a long time.
One of the things you are an expert at is being an advisor. Um, if you were going to give advice to people coming up in your business, like what's the secret of your success? What do people need to learn to do to be good?
Get over failing. I mean, and that's a pithy type of thing, and I probably pulled it out of one of your quotes, I'm sure. But the reality is, um, two, you have to care. People don't care how much you know until they know how much you care. And then secondly, I think to be a good advisor, you really have to become technically proficient. And you gotta study, you gotta read. You just can't watch CNBC or Bloomberg or watch the tape go by and think that you're really digesting information that can be used for a long time. So you got to read a lot of stuff, and you got to read a lot of dry material. You got to read tax, and you got to read trust code, and then you got to go to things. So, but as far as becoming a good advisor, the best advice I could say is become a good listener. And if you become a good listener and you listen to people and you don't fill the gap, you don't think about how you're going to respond and what you're going to say, and then you let silence fill the room, and then that person who with whom you're speaking with says something else and fills it in, and then they really understand that you're listening. You're not just trying to get to a positioning, you know, Tuesday at 10 or Thursday at 4, or if I told you you could do this funnel type of sales approach. To be a good advisor, um, you have to be technically competent, but just as important, you have to be a good listener.
Great. Now, what should I have asked you about?
uh, I think you should have told me that you were going to ask me that question. Um, no, I'm a big fan of what you guys do. This book that I wrote, I will say, it was 15 years in the making. For anybody who's thinking about writing a book, first of all, it's really hard, and secondly, you lose a lot of money in addition to the time. But I'm asked often why I wrote the book, and after the first two correct answers, which is ego and legacy, it really is a culmination of advice I think most people want to know. And I have a lot of friends who are in the industry who've been highly complimentary. Many of them couldn't, write anything in the book because of, competitive pressures, and their compliance department would let them. But I do think that for investment professionals, there's a lot there. And uh, as far as, uh, we've had a lot of people buy them and hand them out to clients and what have you. But to be a good advisor, to be a good investment professional, study hard, do more than the minimum, and things will work out. Have a long-term perspective. Don't get too down, and stick with quality, and things tend to work out.
Chris, thank you so much for sparing the time to talk to us. It was fascinating. We should do it again sometime.
Harry, it's a pleasure. I really would like that. Thank you very much.
Thank you.